Hey everybody, Economic Ninja here. Hope you're doing great. I am having an awesome day. Last day in Louisiana before we leave the Red Pill. I want to talk about something that I believe is very significant. It's something that we've been talking about at the Economic Ninja channel. And so for all of you subscribers here, thank you so much for being here. If you're not a subscriber and you're sort of new to the channel, you've seen it and you like it, if you wouldn't mind, hit the subscribe button, the bell icon. It helps out the channel, helps me get out this information. So these are issues that we've been talking about. The Federal Reserve issued a, well, it's market red alert, right? The key phrases that the news media wants you to hear. But I want to explain something going back into history that the Federal Reserve always warns you before a market collapse, but they like to leave it in very broad general terms because, again, they are reactionary. They're not a force that goes out and does something because they see a problem ahead of time, all right? Because they don't want to be blamed for it. So this is out of the hedge. I'm going to put the link to the article below. Fed issues market red alert, warns stocks vulnerable to quote unquote significant declines. Again, very broad. It says here in the 85-page report published moments after the market close, the Fed warned that, as Bloomberg put it, and this is a quote, prices of risky assets keep rising, making them more susceptible to perilous crashes if the economy takes a turn for the worst. Well, no duh. That wasn't from Bloomberg, just so you know. Asset prices remain vulnerable to significant declines should investor risk sentiment deteriorate, progress on containing the virus disappoint, or the economic recovery stall. Well, geezo, I guess nobody needed to watch the Federal Reserve or read their minutes because they could have just came on this channel. Cool, copy, Captain Obvious, here for duty. So they cite four things, and we're gonna talk about this. Asset valuations, prices of risky assets, generally increased price since the previous report. Then they talk about borrowing by businesses and households. Obviously we know that is off the chart, record levels. Then talking about leverage in the financial sector. We've been talking about that too with insane margin debt. And then funding risk, domestic banks relying on, they're relying modestly on short-term wholesale funding. So let's go back to something that Ben Bernanke gave us, but Alan Greenspan gave us a famous speech, which everybody remembered as when he was quoted as saying, quote unquote, irrational exuberance. He was talking about the stock market run-up of the dot-com bubble. And the thing is that warning, where he warned Congress and warned the nation that we are essentially in a moment of irrational exuberance, and that we need to be careful of the tumultuous times or the tumultuous nature of the stock market, and that if gone unchecked, it's going to collapse. Now, that's paraphrasing on my part, but what I want you to understand is this: that day when Alan Greenspan spoke those words, he knew that we were headed for a crash. He wasn't going to tell you. He was going to let it happen on its own and then come back like a hero and say, this is what we're going to do. We're going to lower rates. That's when I started buying real estate actually in 2001, because as they were trying to recover from the collapse of the dot-com bubble, they were lowering rates, and I saw, ooh, we're pumping up another bubble. And that's really exciting. And that's what this channel is all about, is showing you the different cycles in economics and how just because something is one way today doesn't mean it's going to be that way tomorrow. But guess what? If it bursts and pops, there's going to be another bubble in that exact same asset class. We just need to know the timing. All right. Now, fast forward to today. Jerome Powell absolutely knows that we're going to collapse. As a matter of fact, he knows we're collapsing right now, this minute. But they want to keep these terms and phrases very vague. Why? Because they want to seem and appear like they are here for you, when in all reality, they absolutely aren't. They're here for themselves. They keep making themselves wealthier and wealthier. So what do we do? That's the big thing. You go, okay, Ninja, come on. You've pointed this out. What do we do? Break out of the system. I saw a headline the other day about Rabobank and them issuing a report, and they used the word peasant in the report. I don't have it in front of me, but it was something along the lines of, if the peasants would just start trading in cryptocurrency, the whole system essentially would collapse. It's totally a paraphrase. If you guys remember the news article, throw it in the comment section below. But the reason why I bring that up is because that is what they think of you, as peasants. That is how ruling classes all throughout history have looked at the common man or woman that is a vital part of the economy. The problem is they look at us as peasants and slaves. And that's what I've been talking about forever on this channel. And when I say forever, we're very new. We just turned one. I'm one. But my point being is that I've been trying to point out that we are slaves to this debt system and we have to get out of it. Now, how do we do that? There's many people would say, financial advisors that say it's good to hold 10% of your wealth in gold, right? Because it's an insurance policy. Now, for me, quite frankly, I'm not a professional, money manager. I'm not a fiduciary. Do not take any of this as trading advice. This is kind of stuff that just pops through the ninja's head, right? This is things that I roll over. So I'm like, well, wealthy people throughout time have held a certain amount of money in gold or silver as an insurance claim, like an insurance policy. Remember, I heard George Gammon say it, and it was really a good point when he said, you don't go buy auto insurance hoping that it's going to go up in value. You buy it because if something one day just completely takes your car out or destroys your car, you need to pay for medical bills, it's there, okay? You don't buy it as an investment, all right? So that's what some people do. Other people are getting out of the system by getting into cryptocurrencies, good ones, like Bitcoin, Digibyte, Litecoin, UXTO blockchains that are decentralized and deflationary, okay? They don't just make more and more and more throughout the years and people buy them up like crazy because they got a cool picture of a dog. My point being is that's another way that you can get out of the system. And then thirdly, and this is, I believe, the most important thing, get out of debt. And if you're having a hard time getting out of debt, don't get into more debt. That is the debt and death system right now. That's the slavery that we're in. Now, debt is very good to use to leverage, to build wealth, but that we're gonna go over in other videos in the future and how to do that properly, to use leverage to make money, but you wanna do it safely so it's not in your own name. All right, guys, I hope you got something out of this. I'm gonna link the story below. With that being said, the Economic Ninja is out.